You're listening to the Cash Podcast, creating affluence, success, and happiness with your financial surgeon, Adam Koós, President and Portfolio Manager at Libertas Wealth Management Group at libertaswealth.com.
Hey everybody, I hope that you've had a wonderful first month of the year. It's gone by quick. Lots happened already this year. We've got the Capitol building being rushed. We have a new president in the White House. And we have stocks being shorted through online communities. And we have volatility and price movement like we've literally never seen before in history. So today we're going to be talking about Reddit flash mobs, short squeeze profits in companies like GameStop, AMC, Blackberry, and we're going to go through some stock charts here today as well. So for those of you who are going to be listening on iTunes, if you want to come back and check this podcast out on YouTube, you'll have the charts to show you as well. But before we get started, always, have to have some housekeeping items here. If this is your first time listening or watching, thank you for joining us. The Cash Podcast is produced weekly, and as stated in the intro, Cash stands for creating affluence, success, and happiness. And again, that's our mission. My hope is for you to learn a little bit more on each and every episode so that you can become more successful, wealthier, happier, and more educated than you were before you started listening today. So come back often, check out our older videos if you have interest. Feel free to subscribe. We're both on iTunes and YouTube, like I mentioned a second ago. And in addition, you can also follow me on Twitter at Adam Koós and Instagram at Financial Surgeon. Last but not least, like I mentioned, all links, visuals, charts, and other educational resources are available on our website. So again, if you listen to this podcast and the verbal information that I'm going to share today, and you want to also kind of join along and check out some of the charts that I'm going to be showing you as well, you can kind of come back and check that out later. So let's go ahead and get started here. As for those of you who've been listening or watching for a while, I love quotes. And today, considering we're talking about GameStop, the whole Reddit squeeze, and explaining what that is first and foremost, but then kind of explaining what's going on and showing you some of the stocks and what's been happening. Anthony Massaroni, I got this through the Chart Report, my friends at the Chart Report on Twitter, and Anthony said, which was quoted on the Chart Report, said, "Treat it like a casino and the house is going to win." And I think that something I've been telling a lot of people who've been asking me what's going on with this whole Reddit stock squeeze thing or short stock squeeze thing, I've been telling people that the chances of this ending with a soft landing are pretty small. Things like this don't end well, and we're just going to have to see how it all plays out. The famous last words are "this time's different," and I guess again we're just going to have to see. But let's talk first about what exactly is going on here. What is a Reddit flash mob? Well, first of all, a flash mob, I was talking to my wife, and when she was asking me about what was going on, because she heard some, it's kind of hard to avoid this news. Most everybody knows there's something going on Wall Street when it comes to shorting all these stocks. And that, hedge funds are going bankrupt, and the small investor, the little guys, some of them are getting rich overnight, or at least making a lot of money. I wouldn't say getting rich. You have to define rich, I suppose. But the flash mobs, I explained to her, I was like, you remember back in, 15, 20 years ago when people were doing all those flash mobs where they would just show up someplace out of the blue and they'd do a big dance, and they'd be at Ohio State University, they stormed Ohio Union and they came down the stairs and did this huge dance. That's what I picture when I picture what's going on here in the community, the electronic community or social media communities, specifically with Reddit. So let me elaborate on that, but let me first explain what shorting is. So most people don't realize that when you own a stock, any stock or any ETF, technically that we call that being long the stock. I think that I don't know why this isn't common knowledge, but when anybody takes the Series 7 or 65 license, one of the things you learn very, very early on in this business when you work in it is that you're either long a stock or you're short. And when you're long, you own it, and when you short, you don't own it. You're shorting it. In other words, you're borrowing the shares to sell them on the open market and then make profit on the downside. And again, I'm going to explain what that means here in a second. But I think one of the first things to understand just to kind of help this all make a little bit of sense, is that when I own GameStop, let's just say, I'm long GameStop. When I own AMC Theaters, I'm long AMC. I might say I'm long 100 shares of AMC, and somebody else might say I'm short 200 shares of GameStop. So, but to use the same numbers today, just to keep things super simple, I'm going to keep using $50 a share. So let's just say I own 100 shares of GameStop. That would mean I'm long 100 shares of GameStop, and my goal is for it to go up in value. So what I might say is if GameStop goes down, then I want to sell it if it goes below 48. That would be what's called my stop loss. In other words, it's to keep me from losing more money or to see it go down parabolically and to lose a bunch more than just the $2 per share. So if I buy it at 50, I might say my stop is at 48. My stop loss, we just call it stop. So my stop's at 48. And if it goes below 48, I'm selling it in order to limit further losses. And then if it goes up, which obviously that's what I want to do when I'm long a stock. So if I'm long GameStop, I want it to go up. If it goes up from 50 to say 60, then I made $10 a share. In other words, I profited. When you're short a stock, it's the exact opposite. Let's just say I short GameStop at 50. If it goes down, I make money now. And again, I'm going to explain how this works and why. But if it goes down, I make money. So if it goes up, I need to have a stop loss in place. So if I short GameStop at 50, I might put a stop in at 52 in order to limit my losses, because think about it. If the only way you make money when you short a stock is if it goes down, the most you can make is 100%. And I know you might be thinking, oh, 100%, that's all. But no, seriously, only 100%. So, because if it goes to zero, if GameStop goes from $50 to zero, then you make 100%. But if it starts to go up, and it goes up above and beyond your stop, so if it goes from 50 to 52 and your stop triggers, and you've covered your short position and you no longer are short the stock, if you didn't have that stop loss in place, it would just keep going up and you would keep losing money infinitely, potentially. In other words, if it just kept going up and up and up, you could just keep losing and losing and losing. So that's why shorting an investment is so dangerous. Now, how do you profit from shorting a stock? I just explained kind of the basics, but let's talk about it in a story or an analogy. I always use the same story. So let's just say you and a bunch of friends on the block when you were kids. You're riding your bikes around, and you've got your bike, and then there's new kid comes to town. New kid comes to the neighborhood, and he rides up on his bike and he sees your bike and he says, "It's like, whoa, wow, I really like your bike. It's really nice." And you say, "Oh, well, thanks, appreciate it." And he says, "I'd like to buy your bike." And you're thinking to yourself, "Okay, that's strange, but okay, I'll sell you my bike. Well, how much depends. How much you want to pay for it?" And in your mind, you're thinking, "I know that I can buy my brand new bike at the store, at the bike store, a toy store. I can buy it for $150 right now." And then this kid says to you, "You know what? I'll pay $200 for that bike." And you say, "All right, fine." And so you sell him the bike for $200. And then you go back to the store, you take his $200, and you buy the bike for $150, and you make $50. That's essentially what shorting a stock is. Now, what it literally is it's like borrowing shares, so to speak, of a stock, and you're selling those shares on the open market, kind of like your bike. And then if it goes down in value, because obviously in the case of the bike example, we already have a transaction that's taken place, and we already have a known price at which you're going to sell the bike. But in the market, we don't know which way the stock's going to go. So when you short a stock, what you're doing is you're betting, or you're hoping, or your analysis tells you that you think it's going to go down in value. So what you do is you short the stock, borrowing the shares from a firm. You sell those shares that you do not own on the open market. And then if it goes down, you buy the shares back cheaper and you collect the profit. So, again, another thing I want to point out here is that when you initiate a short position, what you're doing is you're selling, okay? And that's important to understand, because all the stock market is a bunch of market participants buying or selling at any given time. And the more buying enthusiasm that you have, the more buying pressure you have, versus selling pressure, the more price will go up. And the more selling pressure you have versus buying pressure, if there's an imbalance and there's more selling pressure, then price must fall. It's supply and demand. It's an irrefutable law, and there's nothing anybody can ever do to change it. But when you initiate a short position, let's just say a bunch of people are selling a stock. So I own a stock and I'm selling it, and then my neighbor's selling it, and everybody's selling it. That's putting downside pressure on the stock, and the price will go down. If people on top of that start shorting the stock, then what's going to happen is that is going to add additional downside pressure, which is going to send it down further. Now, conversely, if I buy a stock and a bunch of people are buying the stock, whether that's due to earnings, some new news that hit the board, it doesn't really make a difference, but whatever reason people are buying a stock, if there's a lot of buying pressure, price must rise. And as price goes up, if people start covering their short position, because let's just say they were betting on it going down, but instead of it going down, for whatever reason, a lot of buyers come into the market, into that stock, and they start going long the stock. Remember, they're buying stock means they're going long. So if they start buying that stock, a lot of people, and there's more buying pressure than selling pressure, then you're going to see price start to rise, and then the short sellers who are betting on it going down now have to cover their short position, which means they have to buy back the shares at a higher price in order to keep from losing more money. And by buying those shares back that they had shorted or sold, remember, when you short, you're selling. So by buying those shares back to cover that short position and to avoid infinite losses, what happens is the act of covering the short position is buying, which cause more buying pressure on top of the buying pressure that already exists from all the people buying the stock. Now, if you haven't already figured this out, you're probably catching my drift in terms of what has been happening with these, smaller, I don't want to say worthless stocks, but pretty low valued stocks. But what's been happening now, if you understand all those basics, and if you don't, please hit pause, rewind, go back, listen to it again. And then if you have questions, call me. In case you can't tell, this isn't work for me. This is fun. So I love talking about this stuff. I love teaching and educating. And thanks to COVID, I haven't done an investment class in almost a year now. So it's no fun that we don't get to educate any clients anymore these days, except virtually, which is what we're doing right here. So anyway, so what's been happening, if you now understand how shorting a stock works and how the imbalance of supply and demand can affect both long and short positions, then what you need to understand is what was happening is communities like Reddit in particular, was finding the highest shorted stocks. So in other words, the stocks with the highest amount of short interest in their volume, total volume. So if a stock has 1 million shares outstanding, which is very small, by the way, I'm just using that for easy numbers. But if there's 1 million shares outstanding, and let's just say 75% or 750,000 shares are short, then they're saying, okay, let's find those big, huge short positions. Maybe not, and again, just so you know, it's probably not one firm that's shorting the stock. It's probably several firms. Of course, typically companies that are shorting a stock are typically institutional companies, hedge funds, sophisticated investors, basically businesses. So anyway, professional money managers are typically the people shorting the stock. It's very, very unlikely that it's the speculator, the small investor. So these communities, Reddit is saying, hey everybody, online forum, hey everybody, here's some really highly shorted stocks. Let's all get together and let's buy this stock like crazy and start getting those short sellers to have to cover their short position, which will add more buying pressure. And as that goes up, more short sellers whose stop losses were higher, those stop losses will trigger, and then they'll have to buy. And as this happens, it's a domino effect. And it just starts building like this snowball exponentially. And that's what you saw happen. So it's when I say flash mob, what I mean is you've got this, I don't want to say dormant, but you have these stocks that are just kind of hanging out. Nobody's really paying much attention to them. GameStop, who cares? Kids don't buy video games at stores anymore anyway. Who buys used video games? Not many people. They've got retail stores they're paying leases for. At these retail stores, they have to pay employees to work behind the counter. We're in the middle of a pandemic. You've got Xboxes and PS5s and these video game consoles coming out that are, when you buy a game, you just buy it online directly through the console. You download it to the video game machine, and then you just play it. So why in the world would you need to go to a GameStop? In other words, why in the world would I want to own stock in GameStop? In fact, if I'm an institutional, smart, really intelligent money manager, maybe I'm looking at these things and I'm betting, you know what, I think GameStop's probably going to go down in value long term. So I'm going to short GameStop, betting that it's going to go down from, say, $17 a share and continue weakening and weakening and weakening over time, because the model just probably is going to go away. And when I say the model's going to go away, this is exactly like Blockbuster Video. I was just joking with somebody else on the phone the other day about Blockbuster. We were trying to watch The Burbs with my kids. It was one of my favorite movies growing up, and we couldn't find it anywhere on any streaming media device, and we ended up finding it on one, I can't remember the name of it. It's just obscure video streaming site that I had to pay $2 or whatever to rent the movie. But anyway, somebody joked and said, "Well, can't you just go over to Blockbuster and pick it up?" So it's a different world we're living in now. But the point is GameStop is their model is very similar to that of Blockbuster, except you're not renting. You're buying used video games primarily, and maybe some new video games. But anyway, so it made sense, and is what I'm trying to say. It made sense for these institutions, these hedge funds, to be shorting GameStop. So just like it made sense for them to be shorting AMC Theaters. My wife and I went to see a movie last week for the first time in a long time, and we went to the AMC in Dublin, Ohio. And in this AMC theater, they've got the recliner seats. They call them the dream seats. Well, it's like the nightmare seats now. I mean, they've got the leather's all torn up off the seats. One whole row of the loungers wouldn't even recline. And then they had the temperature like 55 degrees. We had to wear coats and put our hands in our pockets the entire time because it was freaking freezing in the theater. So, and on top of that, obviously, there's like 3 couples in the entire theater, and it was the big one, with the 3 sections of seating and like 20 rows. So, I mean, again, who wouldn't want to short a stock like AMC? Is it really going to come back? I mean, people are buying first-run movies on their cable box or on their Apple TV device or Android device, and they're just playing it at home. And you know what? You're paying a whole lot less for soda and candy and popcorn than you do, dropping, $40 on popcorn for a family of 4. But anyway, I digress. I'm going off the chain here. So, all right. So let me show you some stocks, and we'll close for the day. But let me, for those of you on iTunes, like I said earlier, feel free to jump over and check out the YouTube version. If you're on YouTube right now watching this, then obviously you're seeing what I'm seeing here. So what I have here is a list that I created of, I screened it basically, of stocks that are trading above $10 a share, that trade at more than 250,000 shares per day. And the reason I have those screens is because, well, when I'm looking at stocks, obviously I'm not managing money just for myself. I'm managing money for tens of millions of dollars of my clients' money. So I have to be careful. I'm not, buying a stock that only trades at 15,000 shares a day, because it would take me days to buy it and days to sell it. So, and that's actually going to go right into one of my examples of actually about short interest, by the way. So what I did was I built this stock screen, and I've got 2,566 names on it down here in the bottom left. So 2,566 stocks. And when I built this list, what I was looking for primarily was what's the percentage of shares in the float, which means of all the outstanding shares in the float, what percentage are short. If we're trying to find the ones that are being shorted the most, so that might be a candidate for a short squeeze, meaning when we start buying and buying and buying and buying, those shorts start to have cover, and when they cover, they have to buy 2 to cover, and that squeezes the stock northward. So that was the first thing I looked for. So what is the percentage of stocks in the float that are short? And then, almost more importantly, but equally important at the bare minimum, was how many, based on the amount of volume traded per day, how many days would it take for the shorts to get out of the stock? Now, stay with me here. So, if there's 25% of the shares are short out of, say, 13 million, then it would take about 44 days, based on average daily trading volume, for those shorts to get out. In other words, for them to cover their position, it would take 44 days. Now, here's a stock, Tootsie Roll, that has 7 million shares that are short, and which is 42% of the total volume, and it would take them only 38 days. So less volume short, but fewer days to get out, and the reason for that is because there's a smaller number of shares outstanding. So I'm not sure if, we might be getting a little bit nerdy here, and I apologize, but I'm going to bring everybody back home. So what I started doing here is I started going through and looking. Well, here's a stock, Accelerate Diagnostics. Earlier it went up, and obviously the flash mobs got a hold of this one, because here on the 25th it went up 47%. Then it pulled back for a day, 7% went down. Then the next day it went up another 25%, and then that's it. It was a game over. So in 3 days, it went up probably somewhere in the ballpark of, we'll say 75% or so, and then the next day it went down, and now it's only trading maybe 10% above, maybe 15% above where it initiated the flash mob from the breakout. Tootsie Roll. Tootsie Roll's insane. So Tootsie Roll's, obviously, this is not a good stock, guys. I mean, come on. I mean, you look at this thing, it hasn't been doing well. I don't know if people don't like Tootsie Rolls. I'm not a big chocolate fan, but I'm not going to judge. But here we are, Tootsie Rolls trading at $30 a share. This is the 22nd. And then the flash mobs got a hold of it. They jumped on top of this thing, started buying the stock. As they bought the stock, the people who were short the stock, or companies that were short the stock, had to cover those short positions higher, which added more buying. Because again, remember, when you cover your short position to limit more losses, because the stock goes up when you're short, you lose money. In order to cover those short positions, they had to buy. When they bought, that adds more buying pressure, which triggers more stop losses, which triggers more buying pressure. So the first day it's up 15%, the next day it's up 10%, and then the next day after that it's up 11%, which looks like more because technically the stock had traded as high as $58 a share that day. So it went up from 30 to 58. So it almost doubled. And then in one day, it was up as high as 58 and down as low as $39 a share, which is just absolute insane volatility. Now it's headed down here. Then it went down 9% 2 days ago. And then on Friday, it looks like it was up about 2%, which is nothing, but the range was really wide. You can see the bar here, by the way. What you're looking at when you see these bars, the top of the bar is the high of the day, the low of the bar is the low of the day, and then the little notch is where it closed at the end of the day. So if we keep going here, and I could start flying through a bunch of these. This is Ligand Pharmaceuticals. You can see that this one's kind of just been screaming northward. It has earnings coming up, actually, so that'll be interesting to see if people start selling this thing ahead of earnings. But this is different. This stock's a little bit different than the others, and the reason why is because it has high relative strength. Some of that high RS, or relative strength, meaning it's 90. A relative strength rating of 92 means that this stock has been performing better than 92% of other stocks on the exchange, or in other stocks, period. It also has really, really good year-over-year earnings at the end of September, as well as positive sales. And you can see if you go back prior quarters, negative 58. Negative 23, then positive 47, positive 112. So this is growing earnings, growing sales. So this is actually a good company. So what ended up happening down here, you can see that there's a lot of people or a lot of companies that were short this stock, and still are, by the way. And they're just betting, maybe because it's had this huge exponential rise, they're betting that it's going to fall or revert to the mean, or maybe somebody or some people know something that nobody else knows about these earnings that are coming up in 4 days that might affect the stock negatively. Who knows? But at any rate, the fact that the price started going up started squeezing those shorts. But this is actually a decent stock. So that's kind of something that makes a little bit more sense than like your GameStop. Let's see here. What else do we have? Nectar Pharmaceuticals. It hasn't done much yet. I don't know that it will. By the way, don't take any of these comments as an indication that you should open up a Robinhood account and start buying these stocks in hope of a short squeeze and being part of a flash mob next week. Please don't do that. I mean, if you decide to do it, and by the way, for those who have, congratulations. I think it's great that that these younger primarily younger investors have been making money hand over fist, gambling on these stocks and being a part of these communities. There's nothing wrong with that, obviously. Like, here's another one, National Beverage Corp. The symbol is Fizz, which, again, had decent earnings, decent sales, so not a horrible stock to begin with, right? Kind of a steady uptrend with some choppiness. We've actually owned this stock before, but then all of a sudden here, on the 25th, it bounces up 13%. The next day it goes up 16%. The next day it's up 40%. And then on Thursday it was down 13%. And then on Friday it was down 3.5%. And I think that we'll have to see what happens. But it looks like right now, as a snapshot in time, that some of these stocks that have been screaming northward as a result of these short squeezes have been kind of calming down. And then maybe the excitement is starting to wear off a little bit here. I'm going to show you a couple more here. Let's see. I'll show you ones that we've been talking about in the. Oh, there's iRobot. So iRobot. I don't know if you want one of those things cleaning your floor. I've heard so many stories about these electronic, automated robot vacuum machines. Your dog poops on the floor, and then the robot smears your dog poop all over the house. It's not funny, I guess, but I don't know. Maybe it is funny. So it's up 17% on the 25th. Flash Mob gets a hold of this thing. It's up 9% on the 26th. And then on the 27th, it's up 27%. And then since then, it's come down. And by the way, when you have a stock that goes up from, say, $100 a share, and it goes up to, 115, that's, in this case, is a 17% gain. And then it goes up and it closes at 126, so it's up 9% that day. And then it goes up and it closes at $160 a share, and that means it was up 27% that day. So you can make a bunch of money in a stock like this, and GameStop's going to be really the best example. And then it can go down 50%, and it doesn't sound like that much because you can make 1,880%, but when you lose 50%, you just lost half that 1,880%. So there's this thing called the sequence of returns that if I make 1,880% on a stock, that sounds amazing, and it is, by the way, that is amazing. But if I lose 50%, which just doesn't sound like that much, what I actually lost was 940%. Not mathematically, but in terms of the upside that I achieved, that's half, right? So if I made 1,880% on a stock like GameStop, and I lose 50%, I lost 940% of that, 1,800%, 1,880. I'm using 1,880, by the way, because at one point, when I was looking at GameStop last week, that was where it was. So you know what? Let's screw it. Let's just look at GameStop. So here's GameStop. Oh man, I didn't look at it yesterday, so the chart's just gotten a little insane here. So GameStop trading at $12 a share, up to 22. Something's going on here. $17 a share. Then all of a sudden, on the 13th of January, it's up 57%. And people start paying attention. 57%. Why in the world is GameStop going up 57%? That'd be like Blockbuster going up 57%. Why? Is there, in the middle of a pandemic where we all have streaming devices, did we have a vaccine now, so did everybody cancel their Netflix subscriptions? Did you cancel your Amazon Prime subscription? Is everybody rushing back to Blockbuster Video? The only one left in the country to go buy videos, and so therefore Blockbuster Video is going to go up 57%. No, there's something else going on here. So it's up 57. This is GameStop. GameStop's up 57% on the 13th. Then it's up 27% on the 14th. Then it comes down 11% on the 15th. Then we have the holiday weekend, Martin Luther King weekend. Then it's up 11%, and that was the day after Martin Luther King Day on the 19th. And then on the 20th, it's down a little bit, barely went anywhere on relatively low volume as of recent, I should say. And then it's up 10% on the 21st, and then things just start going nuts. This idea of short squeezes and Reddit and these communities hits the news. People start looking for it. They find it, they start buying into it, and now GameStop's up 51% just on the 22nd. Then on the 25th, so Monday, this past week, it's up 18%. Then on the 26th, it's up 92%. Then on the 27th, it's up 134%. 28th, it's down 44% in one day. And then yesterday, it was up 68%, we'll call it. I'm rounding up. So that's GameStop. AMC, I'll stop nerding out here in a second, but here's AMC. Oh, this looks like a wonderful stock. AMC Theaters, 55 degrees, Nightmare Loungers. Yeah, anyway, so here all of a sudden the flash mob gets a hold of this bad boy, and we're trading at under $5 a share. It's technically a penny stock. And then in one day, it goes up 301%. The next day, it's down 56%. And then on the 29th, which is yesterday, it's up 53%. That's AMC. Blackberry. This is the last one I'm going to show you. Blackberry. Who owns a Blackberry? Does anybody own a Blackberry? And did I dream this No, I must have dreamt this last night. You can tell I do this too much. I start dreaming about stocks. I had a dream last night that in order to activate your Blackberry, you have to go to the store. I wonder if that's true. I doubt it. Anyway, so here you've got, I don't know why in the world Blackberry started going up here. I don't believe flash mobs had started on the 1st, but maybe this most secret, smallest flash mobs had started coming out on the 1st of December here. But prices, generally trading around $5 a share, down as low as $2.70 going back to last March during the Corona crash. And then here, the 14th of this month, so 14th of January, BlackBerry goes up 22.5%. The next day, it's up 8%. Then we have the holiday weekend. The Tuesday after Martin Luther King Day, it's up 25%. Then it's up 3.5%, up half, and then it's up 9% that Friday. And then last week, it's up 28% on the 25th, 5% on the 26th. The 27th, it was up 32%. And then Thursday, it went down 41%. You lost almost half your money. If you bought on Wednesday, you lost half your money on Thursday. And then it's down 3.75% to close on Friday, yesterday. So anyway, so that's kind of what's going on here, is that you have these institutions that, when they short a stock, a lot of it, and then you have all these smaller investors coming in and teaming up together to build this beast of a buying scheme, which is not technically illegal. They're pushing the price up, which triggers these stop losses, which triggers more buying up from the short sellers. Those who are short have to cover and buy, which sends the price higher, which then triggers more stop losses that were higher, which causes more buying. And again, you get this exponential domino effect, all created by this flash mob of smaller investors. And it's been pretty fascinating. I wouldn't recommend anybody jump on this thing and start trying to get rich. I think, like I said earlier, I don't think that this ends with a soft landing. I don't think this ends with a bunch of people continuing to get rich forever. To the contrary, I know that there's a lot of opinions out there about whether or not this should be allowed in social media, whether or not it should be okay for these social media companies through, say, free speech, to be able to congregate and buy up these stocks as a group to try and squeeze short sellers out. For the same reason that I don't think that the SEC or the FINRA would look very kindly on the idea of these same websites congregating to all short a stock and drive a company to zero, which you can imagine the repercussions that they might face if they were to do that, because it'd be a lot different, right? Right now, what's happening is these flash mobs are bankrupting hedge funds and they're bankrupting institutional money managers. But if you did the opposite, you'd be, I don't want to say bankrupting the companies, but you'd not only be hurting the share price of the companies that may be very good companies, but you would also be hurting the investors that own those companies. So this is a very interesting time, and I think that again, I can't reiterate more. I would not be jumping on this bandwagon and trying to be, the next person who gets rich quick. And again, we have to define rich, of course. I know that I have some friends and you have some clients who've been, playing around with this idea and throwing $1,000 at it just to play around. And I don't think there's anything harmful in that, but I just think you want to be really careful. Don't use your serious retirement dollars to start gambling with online, flash mob stocks. I think you could lose pretty quickly, if not faster than you can win. So anyway, so with that all being said, let me get back to our PowerPoint here. So I think I'll just end for today. I don't even know how long I've been talking, so probably too long, typical. But anyway, we're going to end our show today, but thank you so much for watching. If you know somebody who's been asking about this, these flash mobs, if you know somebody who's been wondering what's going on with GameStop, what's been going on with short selling, or just somebody who wants to understand what short selling is and how it works, please feel free to pass this episode along to your friends and family. And if you'd like to discuss your personal situation further, if you're not a client, remember that you never have to be a client to ask a question. And if you'd like to set up an intro call, just a 20-minute intro call or a Zoom meeting, just to get to know each other, answer some questions you might have, feel free to go to our website at libertaswealth.com. And on our website, you can go to the contact page, and you can actually schedule an intro call in the calendar directly from our website. You'll get access to my calendar. As I always say, there are thousands and thousands of podcasts out there, and you chose to give ours a listen today. So thank you so much for tuning in. Be sure to subscribe again on iTunes and YouTube. And remember, you can sign up at libertaswealth.com to get these updates, as well as our other screencasts. We have videos, articles that we write, and we can have them all delivered directly to your email inbox. Feel free to follow us on Facebook, which is facebook.com/Libertas Wealth. I'm also on Twitter at Adam Koós, as well as Instagram at Financial Surgeon. So thank you so much once again for joining us, and we'll see you next time.
Thank you for listening to the Cash Podcast with your financial surgeon, Adam Koós. To see any charts or images that were mentioned in this show, or to check out additional articles, videos, and other educational resources, head over to libertaswealth.com.